You are listening to Uranium Spotlight, your weekly podcast on the forces shaping the global uranium fuel market, sponsored by PurePoint Uranium Group. Uranium Spotlight isn't just a podcast, it's a platform. Visit purepoint.ca to access in-depth market briefings, sector analysis, and the inaugural Behind the Curve report, understanding when and how the uranium market turns. If uranium matters to you, you're in the right place. And now, your host, Chris Frostad.
It's July 28, 2026, and this week on Uranium Spotlight, a quiet summer spot market that keeps drifting higher, an American producer's delay that exposes a much larger fuel security problem, a physical holder warning that volatility is coming, and a Namibian mine that has finally hit its stride. The uranium spot market opened last week at $85.50 a pound. It closed at $86.25, a gain of 75 cents. That move came on very little volume. 6 spot transactions cleared last week, totaling 450,000 pounds. That is 3 fewer deals than the week before. Yet every deal printed higher than the last. Tuesday cleared at $85.75. Wednesday at $85.85. By Thursday, the buyers were paying $86.25. Delivery locations drifted apart through the week, then returned to parity on Friday. The Sprott Physical Uranium Trust also came back. It bought on Tuesday, its first purchase since last May. It still holds $111 million for future buying. The long-term price held at $94 for July, and no change on the month, but it's up nearly 10% since January. That gap is the story. Spot is drifting sideways in the mid-80s. Term is grinding steadily higher. The term market is where the real work is happening. 2 awards were confirmed last week. One American utility has made its selection of up to 400,000 pounds for delivery in 2028, 2030, and 2032. Another American utility is finalizing a decision on up to 1.4 million pounds. A non-American utility is reviewing offers for roughly 500,000 pounds a year across 2027 and 2031. 3 more utilities are working through requests for information, with deliveries starting as late as 2031. For investors, the key takeaway is that a thin summer spot market is not a signal of weak demand. It's a signal that demand is moving somewhere else. Spot volume tells you what traders are doing. Term activity tells you what the people who actually burn the fuel are doing. Right now, those 2 markets are telling very different stories, and only one of them involves reactors. Peninsula Energy has told the market it needs another year. The company's Lance project in Wyoming has been slow to start up. Peninsula has now withdrawn its 2026 production guidance entirely. That guidance had called for 500 to 600,000 pounds of U3O8. The problem is technical. Peninsula switched Lance to a low pH acid leach. In situ recovery works by pumping solution down through the ore body. The solution dissolves the uranium out of the rock. The loaded water is then pumped back up, dried, and processed into U3O8. Change the chemistry of that solution and you change everything downstream. It has not gone to plan. Lance has a nameplate capacity of 2 million pounds a year. That matters. Eventually, this mine could make a real contribution to American supply, not just this year and not next. Now widen the lens, because this is where the story gets serious. American uranium production last year came in at just over 1 million pounds. American reactors consume close to 50 million pounds a year. Domestic mines cover about 2% of domestic demand. There are 94 operating reactors in the United States. That is more than any other country in the world. Every one of them runs on fuel that America does not dig up. So the United States imports. The question is from whom? Look at the top 9 uranium producers globally: Kazakhstan, Niger, Namibia, China, India, Russia, Uzbekistan, Canada, and Australia. Almost all of that production is already committed elsewhere, excluded by sanctions or politically unavailable to Washington. Canada and Australia could, in theory, supply America for decades, but large portions of their output are already tied up with India and European utilities. Australia also bans mining across regions holding much of its resource. That is remarkable, given Australia holds the largest uranium reserves on Earth. The United States, meanwhile, has made almost none of these deals. This is the fuel security problem in its simplest form. It's not a question of whether the uranium exists, it's a question of whether America has a claim on it. And the timing is difficult. Data center build-out is pushing electricity demand higher across the country. Nuclear is the obvious answer to that demand, but a reactor without fuel is just a very expensive building. For investors, the key takeaway is that Peninsula's delay is not really a Peninsula story. It's another data point in a pattern. Either domestic production finally scales, or Western utilities pay up for secure pounds from politically stable jurisdictions. Both outcomes favor producers with permitted assets in the West. Yellowcake has reported on its quarter, and the message is about volatility. Yellowcake is a listed uranium holding company. It does not mine anything. It buys physical uranium and sits on it. Holdings now stand at 24.4 million pounds. That figure includes 1.16 million pounds purchased from Kazatomprom but not yet delivered. The company also retains the right to buy further material from Kazatomprom whenever it chooses. Chief Executive Andrei Lanenberg framed the quarter clearly. Spot prices stabilized around the mid-80s. Longer-term price indicators strengthened markedly. The long-term price reached $94 a pound, a rise of nearly 10% in the first 6 months of this year. His read is that utilities are increasingly focused on securing future supplies as the market tightens. On demand, he pointed to expansion plans in North America, China, and Europe, and added industrial users and data centers to the list. On supply, he was blunt. Demand growth is outpacing mine development. Without significant investment in new production, the gap widens. The trading detail in the report is worth pausing on. During the April to June period, roughly 95% of spot transactions were conducted off-market. Intermediaries, traders, and financial entities accounted for 92% of the volume. Producers supplied just 8%. Think about what that means. The visible spot price is being set almost entirely by financial players trading pounds amongst themselves. Producers are barely in the room because the material is already committed under term contracts. Daily prices averaged $85.52 over the quarter. That compares to $86.63 in the previous quarter. A tight range and a quiet one. Yellowcake attributes the earlier volatility to financial buying, including the Sprott Trust. The company also grew its position during the quarter and launched a $10 million share buyback. That is a holder buying back its own discount to net asset value while continuing to accumulate metal. It's a statement about what management thinks the pounds are worth. Looking forward, Yellowcake describes sentiment as cautiously positive. Reactor construction continues at pace, particularly in China. Longer-term build targets are emerging in the United States and India. The company expects those requirements to be met through term contracting, potentially supplemented by asset acquisitions and investments. For investors, the key takeaway is about where price discovery actually happens. A spot market where producers supply 8% of volume is not reporting the physical balance. It's reporting positioning. The term price is the more honest signal, and the term price has climbed almost 10% this year, while spot went nowhere. Watch the term market. That's where the utilities reveal what they actually believe. Paladin Energy has closed the book on financial year 2026, and the ramp-up is finished. Langer Heinrich in Namibia produced 4.82 million pounds for the year. Guidance was 4.5 to 4.8. Paladin beat the top of the range. Sales came in at 4.35 million pounds, also above guidance. Cost of production for the year was $43.30 a pound at the low end of the range. The fourth quarter looked different. Costs jumped to $51.60 a pound. That reflects the move to full mining. The previously mined stockpile is now depleted. Everything processed from here comes out of the pit at longer haul distances. Guidance for financial year 2027 is 5.1 to 5.6 million pounds produced, 4.8 to 5.3 million pounds sold, and costs of $44 to $48. If spot averages $80, Paladin realizes $72. At $100 spot, Paladin realizes $83. At $120, $93. That's a contract book that lags the market badly. Paladin realized $70 a pound late last year against a spot price in the mid-80s. Investors buying Paladin for uranium price leverage are getting a muted version of it. In Canada, Patterson Lake South cleared a genuine hurdle. The regulators confirmed the construction license application is sufficient to proceed into assessment. Paladin has since signed an administrative protocol targeting completion of hearings by the end of calendar 2027. Exploration delivered as well. The Atlas discovery sits 3.5 kilometers south of Triple R. 7 of 8 holes hit mineralization. The best intercept ran 8 meters at 1.75%, including 3 meters at 4.25%. For investors, the key takeaway is that Paladin has solved its operational problem and now faces a commercial one. The mine works, the balance sheet is sound, with $265 million in cash, But the contract book was written for a weaker market, and it'll take years to reprice. The near-term value here sits in Patterson Lake South and in the ground at Atlas, not in this year's pounds.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to the latest developments shaping the uranium fuel market and its role in the global energy landscape, sponsored by PurePoint Uranium Group. While our passion for the sector is undeniable, nothing discussed here should be considered investment advice. Our mission is to provide a clear, balanced view of the forces influencing uranium prices and the nuclear fuel cycle. For deeper analysis and market briefings, visit purepoint.ca. Join us again next Tuesday for another edition of Uranium Spotlight.